In Chapter 9, Part B, we'll complete our coverage of the weighted average cost of capital. We've calculated all the needed cost of capital components for the WACC formula. We just need to find the weights for each type of capital, plug them in to get our cost of capital. We also need to discuss factors that affect a firm's cost of capital, how and when to adjust for risk, and finally look at some common mistakes to avoid. To bring us back, recall the basic weighted average cost of capital formula. The weights are the percentage of each type of capital in the firm's capital structure. Most firms have target weights that they strive for. If you're on the inside of the firm, you'll probably have access to those numbers. If you have target weights, use them. Due to fluctuating market values, a firm is almost never right on their targets, but they're trying to stay close. These are the target capital structure weights given in the mini case. Debt 30%, preferred 10%, equity 60%. If you don't know a firm's target weights, then market value weights are the next best option. Use current market values. The market value of common and preferred can be found as the number of shares outstanding times the current market price. For debt, use the number of bonds outstanding times their current quoted price. With debt, it is permissible to use book value, especially if you're including short-term debt. Estimating the market value of debt uses the current price of an outstanding bond and the number of bonds outstanding. Preferred stock value uses the same approach, current market price per share times the number of shares outstanding. And the same for common stock. With these three values, we can find the market value weights. From there, we simply compute the percentage each form of capital is of the total firm. For our case, the firm's market value weights are very close to their target weights. Often, market value weights temporarily deviate from targets due to changes in stock price. We now have everything we need to calculate the weighted average cost of capital. Substituting in the equation, we find a cost of capital of 10.83%. What outside factors affect a firm's weighted average cost of capital, and how can a firm control it? Rising interest rates raise all capital cost. Consider that some version of the risk-free rate is in both cost of equity and cost of debt calculations. If investors become more risk-averse, the market risk premium will rise. If corporate tax rates rise, it will lower the cost of debt and thus lower the cost of capital. A firm's capital structure influences its cost of capital. Debt is less costly than equity. We'll see in Chapter 15 how this works. If a firm pays out more in dividends, it will have to raise more outside funds, raising the cost of capital. If a firm pursues risky investments, investors will demand a higher return on both debt and equity. You hear firms talk about their hurdle rate, the rate of return required on all investment opportunities. Actually, using one rate, the weighted average cost of capital for all decisions, is not appropriate. It's even dangerous. The weighted average cost of capital we've calculated reflects the risk of an average project of the firm. If the firm is considering higher or lower risk projects, it should adjust that cost of capital accordingly. Different divisions, different projects may have different levels of risk as well. Strictly using the 15% cost of capital versus the expected returns for each project leads to accepting A and B and rejecting C. But if required return, a risk-adjusted measure, is computed for each project, the results change. Now A is rejected, C is accepted. So what happens when we use the weighted average cost of capital as a hurdle rate, the red line? We accepted a risky project that we shouldn't have, above the red line, below the blue line on the right. And we rejected a less risky project that we should have accepted, above the blue line, below the red line on the left. If the company does this on a consistent basis, it will become riskier over time. So how can we adjust the firm's cost of capital for individual divisions and projects? We could estimate a cost of capital for each division alone, but that requires inputs that may be hard to get. The pure play method involves finding comparable companies exclusively in the project's line of business and using the average of their betas. Sounds easy enough on paper, but in reality it is not easy to find comparable companies or ones that are only in the project's business. If the data for the accounting beta method is available, then it can be used, but this is usually not the case. Consider, how valid would a project ROA be on a project not yet launched? In the mini case, the firm is considering establishing a new division and has gathered the above data on similar firms. Target debt ratio 10%, cost of debt 12%, risk-free rate 5.6, tax rate 25, division beta 1.7, market risk premium 6. Using the comparable firm's data, we can estimate a cost of equity and consequently a cost of capital for the new division. Recall that several slides back we found the overall cost of capital for the firm is 10.83, quite a difference for this division. Using 10.83 would greatly overestimate the attractiveness and profitability of this new division. Frequently, firms issue instructions to divisions to subjectively adjust their overall cost of capital up or down, say plus or minus 2 or 3 points, for more or less than average risky projects. We've got an estimate for retained earnings, but what if the firm chooses to or has to issue new common stock to raise funds? New issues carry flotation cost, and they're pretty high for common equity. Plus, a mature firm issuing new equity is a negative signal to the market, which may drive down the stock price before the actual issue occurs, forcing the firm to issue more shares to raise the needed funds. Given the same data, but including flotation cost of 15%, we now get a cost of new equity of 13.6. Flotation fees on new equity can be costly depending on the size of the firm, the amount of stock issued, and the risk of the firm. Due to the high flotation and signaling costs, firms issue new equity rarely. Flotation costs for debt are significantly lower and frequently ignored in calculations. Let's close out the chapter reviewing 4 mistakes to avoid in calculating a firm's weighted average cost of capital. We'll take each one individually. We need to use the marginal cost of debt, the cost to issue new debt right now, reflected in the yield to maturity on any currently outstanding debt. The historical coupon rate, while probably the market rate at the time the debt was originally issued, is irrelevant now. When estimating the market risk premium, don't mix current and historical measures. Target weights are the best if you know them. Market value weights are the best alternative to target weights. The book value of debt can be used, especially if it's short-term debt. And finally, capital components are sources of capital that come from investors. Common equity, preferred equity, and debt. That's all. That ends Chapter 9.